Okay, today we're doing chapter 8-1. We're going to talk about closing entries and the process of closing entries. So we are journalizing and posting closing entries for a service business organized as a proprietorship. Okay. First of all, we need to remember why we have permanent and temporary accounts. So our permanent accounts, those are the ones that they stay with us. Okay. They don't have we don't have to zero them out every period. Okay, so our assets would be like that. You think about the balance sheet. Okay. So if we read the definition here, it says accounts used to accumulate information from one fiscal period to the next are called permanent accounts. Okay, so from one fiscal period to the next. So they're not zeroed out. Okay. Permanent accounts are also referred to as real accounts. Then we have the temporary accounts. Those are known as nominal accounts. Okay. These are the ones that are transferred to the owner's capital. Those would be accounts like all of our expenses we need to close out for the period. Okay, we need to find out what our income was, so we're going to close that out if it was an income or a net loss, right? And that's where we start closing everything to what's called the income summary. And I know some of you guys have been asking about that. We're going to be using that income summary in chapter 8. So why do we need to have temporary accounts? Journal entries used to prepare temporary accounts for a new fiscal period are called closing entries. Okay, so remember our journal, that is the diary of the business. That is everything that is happening. Okay, we also have to have closing entries so that we understand and we're seeing that we're closing these temporary accounts and we're bringing them back to zero for the period. The temporary account balances must be reduced to zero, right, at the end of each fiscal period. When revenue is greater than total expenses, resulting in net income, the income summary account has a credit balance, as shown in the T account. Okay, so here's our income summary account, right? We have our total expenses, and we have our revenue. Okay. When revenue is greater than expenses, then there is going to be a credit balance, right? Credit balance is the net income. When total expenses are greater than revenue, this is what's called a net loss, right? We didn't make any money. The income summary account has a debit balance. Okay, we have our income summary, and we will have a debit balance. Okay, that means that our expenses were more than our sales. Okay, so let's look at a closing entry for an income statement account with a credit balance. We have our sales account. Okay, the balance in sales is $5,820. But we need, and that is a credit balance, right? The sales account has a credit balance. In order to close that account, we need to create a debit entry. Okay, so we're going to debit sales for $5,820. And then we're going to credit the income summary. Okay, so that way we have a debit and a credit, and they both equal. Okay, Okay, we've closed out our sales. It's showing 0. And now we have a credit balance in our income summary. And this is what the journal entry is going to look like. Okay. So the top one is showing our worksheet, and then down below you can see our journal entry. So we have the 31st, that's the end of the period. Sales, we have a debit, right? Because our normal balance in the sales account is a credit, right? We want to bring it to 0, therefore we have to have a debit in the same amount. Okay, that's where we get our debit. And then we have to have a matching credit. That is going to go to the income summary to close out sales for the period. Okay. This is exactly what you're going to do on the exercise. All right. You'll put in closing entries and then sales, debit, income summary, credit. Okay. Okay. Closing entry for income statement accounts with debit balances. The top is from the worksheet, right? The income statement. So this is the second entry that we're going to make in our closing entries. So we have all of our expenses. Okay? They each have debit balances. In order to close them, we need to have a credit in those accounts to zero out the balance. Okay, and you'll see that down at the bottom where we have the journal. We look at the journal. Now, just ignore where it says income summary and it has a total there. Okay, because at this point, we don't know what the total is. Okay, we know what our expenses are. We know they have debit balances. So we need to we need to credit each of these accounts. So you can see we have each of our expenses listed in the journal, and we have them listed as credits. Okay, then we'll total all of those up, and we'll create a debit entry to income summary for that amount. All right, we zeroed out our expenses, and we took that total, and we now have a debit in our income summary. Sorry about the dog barking. All right, there's our date, income summary. Guaranteed he's barking at another dog and not a human. Anyway, okay, we have credit to close. All right, so take a look at this one. Okay, now we have closed our sales to the income summary. We have closed our expenses to the income summary. And now we're going to take a look at our net income, okay, which is sales minus expenses, right? So we have that total on our worksheet, 3,162. So we're going to take that amount and we're going to credit capital. Okay, we are crediting capital because we have a debit for our income. Okay, and also, right, this is net income, so that's going to increase capital, and we know that capital has a normal balance on the credit side, right? So our capital account is going to increase by net income. All right, so we put in our credit for 3162 to capital. Our debit is going to go to income summary. Okay? That way we are closing out our income for the period. All right. Next, we're going to move on to the drawing account. And remember that drawing is taken directly out of capital. Okay? So we have our capital account and our drawing account. Okay. Drawing it comes out of capital. Sorry, I just said that. So what we're going to do here is drawing has a normal balance on the debit side. So we would need to credit drawing, right? Because we want to close out our drawing account. Okay. And in turn, we want to debit our capital account for that same amount. Okay, so our debits and credits match. Our drawing account is now zeroed out, and our capital account has been decreased by $1,150. Okay. All right. So let's answer these questions. What do the ending balances of permanent accounts for one fiscal period represent at the beginning of the next fiscal period? Okay, what we ended with, right, for one fiscal period, what is that going to be for the next fiscal period? It's going to be the beginning balance, right? What do the balances of temporary accounts show? They are showing the changes in owner's equity, okay, owner's capital for a single fiscal period, right? So we have our sales minus our expenses. That's either net income or net loss, right? And then we have our drawing account. Those are all things that need to be closed out so that we can see what owner's capital looks like at the end of the period. Okay. List the 4 closing entries. All right. So we just went through it. Number 1, we close income statement accounts with credit balances. Okay. So that's where we're going to close our sales. And then we're going to close our expenses. Next one, an entry to close income statement with debit balances. Okay, we're going to close our income. And then an entry to record net income or net loss and close the income summary account. Okay, this is going to be either added or subtracted from capital, right? And then closed to the income summary account. Then an entry to close the owner's drawing account. So that is going to go directly against owner's equity. All right.